Good morning, and welcome to today's webcast, Data Management Lessons, Pillar 2, and Equity Compensation. Before we begin, I'm going to play a brief housekeeping video.
Welcome and thanks for joining us. Our webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% or 3 of the 4 polling questions, which we'll ask throughout today's presentation. Polling questions will appear within the slide window. To participate in the polls, please click on your answer and be sure to hit the Submit button to record your response. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry, if you can't download your CPE certificate today, we'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our group CPE attendance sheet to receive credit. The attendance sheet is available in our slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit only can be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Before we get started, I wanted to share our big news, that Moss Adams and Baker Tilly have joined forces to redefine accounting, tax, and advisory services for the middle market. It's really exciting, and you can read more about it on our website via the link in the slide deck and handouts widget. With that, I will turn over to Mark to get us started.
All righty, thank you. You'll notice this title is called Chocolate Isn't the Only Swiss Export. And I'll admit, chocolate is a pretty interesting topic for this early in the morning. Unfortunately, I don't have samples to share, but I do have a different kind of Swiss export to talk about, which are profits. Switzerland has long been a destination for multinational companies looking to reduce their tax burden. And before we go into Pillar 2, it's worth stepping back. For decades, companies have used gaps between tax jurisdictions to shift profits away from where the actual business activity was taking place. For example, a US headquartered company might be facing a 25% effective tax rate at home. By shifting profits to Switzerland, they might be able to lower it to about 6%. But here's the issue. Profits being generated far outweigh the actual business presence in there. Imagine billions of dollars flowing through the country where the company employed just a fraction of its global workforce. The numbers doesn't really reflect the real economic activity. The impact? We have $8 billion in profits that have shifted from the US to Switzerland. 2.4 billion of those are US tax that's been avoided, and eventually an IRS tax investigation. As you'll see in the screen, we have Swiss profit share is really 85% at the end of the day, but the staff really doesn't quite end up. This example illustrates the very problem Pillar 2 is designed to address. Disconnects between profit reporting and actual economic activity, and it is exactly why Ravi and I are here today to unpack what this means for you, your data, and your reporting process. So good morning. My name is Mark Hedlund. I'm a director specializing in equity compensation financial reporting here at Baker Tilly. Over the next 15 minutes, Ravi and I will discuss Pillar 2, what it is, why it was created, and how it impacts companies. Ravi, take it away.
Thanks, Mark. My name is Ravi Ganapathy. I'm a transfer pricing senior manager at Baker Tilly. Pretty excited to be doing this webcast along with Mark here. So we can go to the next slide. We shall quickly go over the learning objectives. So today we will recognize how data quality and coordination challenges impact financial reporting outcomes. Then we'll get into Pillar 2 details, kind of walk you through the compliance requirements of Pillar 2, and also make sure that organizations are got process readiness for Pillar 2 compliance. And then we will use equity compensation as a case study to explore common data and reporting challenges, and also kind of talk about how automation and cross-functional collaboration are critical to solving them. And then finally, we will identify strategies to strengthen your organization data infrastructure, including process improvements and automation techniques that support scalable, audit-ready reporting. I think we've got a polling question coming up next.
All right. Our first question is, which best describes your organization's current global or multi-jurisdictional reporting needs? A, significant multi-country reporting requirements. B, some cross-border compliance or tax reporting needs. C, operate mostly domestically but anticipate growth. D, operate solely domestically with no cross-border activity. I'll give everyone a few moments to respond. And just a reminder, to participate, please click the button next to the answer you choose and hit submit. Give everyone a couple more seconds here. All right, let's take a look at the results.
All right, here, seems like it's kind of evenly split between the first three options, with the last option, which is operate solely domestically with no cross-border activity being the winner here. So that's good to know. So I think with that, I think we can go to the next slide here. We'll talk about BEP. BEP stands for base erosion and profit shifting, just like what Mark mentioned previously. This is a strategy adopted by multinational companies to shift profits from a high tax jurisdiction with a lot of economic substance and activity to a low tax jurisdiction where they don't have any substance or very little substance in there. And this is mainly done to reduce the effective tax rate for the entire group and pay minimum tax on the global profit. And this base erodes the tax base of countries in which multinational groups are operating. So why does it matter, and why is that BEPS an issue? BEPS really put the country at a disadvantage because they reduce the tax rate of that particular country in which multinational companies have significant economic presence and they don't pay their fair share of tax. It erodes public trust in both domestic and global tax systems, and also it deprives governments of tax revenues to spend on critical infrastructure and other public services. So statistically, there's about 4 to 10% of global corporate income tax revenue is lost annually, and through that, with multinational companies shifting their profit to low tax countries. So to combat BEP, we need to talk about what OECD has been doing. So talking at a very high level about OECD, OECD stands for an organization for economic cooperation and development. It's an international organization. They come up with public policies and reforms for social, economic, and environmental reform. It was founded in 1961, headquartered in Paris. They have 38 member countries. From a tax perspective, they play a very critical role. They come up with OECD transfer pricing guidelines to come up with guidelines on how intercompany transaction needs to be priced. OECD has also come up with 15 action items to combat BEPS. And also with BEPS 2.0, they come up with a two-pillar solution, Pillar 1 and Pillar 2. They aimed at trying to create a more transparent and fair international tax system. So yeah, so the OECD two-pillar solution has two pillars, Pillar 1 and Pillar 2. Pillar 1 is aimed at or targeted towards the digital economy, mainly applies to companies with over 20 billion in revenues, global revenues, and has profit over operating profit of about 10%. And then it assigns that excess profit of 25% to in countries where they have market jurisdiction. So Pillar 1 is still under work. It's not finalized yet by the OECD, but it applies to very large corporations. Pillar 2 is what we're going to talk more in detail today. It mainly is targeted to combat debt, and it is a global minimum tax of 15% across all jurisdictions in which the multinational enterprise is operating. And why Pillar 2 matters? It basically tries to curb tax competition amongst tax jurisdictions where they try to incentivize multinational enterprises by giving tax incentives to operate in their country. It also creates fairness and transparency in the international tax system. So that will go to the second polling question.
All right, our second question is, how confident are you in your organization's ability to consolidate accurate data from multiple systems or departments? A, very confident, systems and processes are well integrated. B, moderately confident, some integration, some manual work. C, not confident, data is siloed or heavily manual. And D, unsure / don't currently consolidate at this level. And I'll give everyone a few moments to respond. And for those of you that would like a copy of today's slide deck, you can download them from the folder that says slide deck and handouts. We will also be sending the slides via email after the webcast as well. All right, let's take a look at the results.
Okay, the results are out, and seems like the majority is 56% was moderately confident, some integration, some manual. Good to know. All right, can probably quickly go over this slide here. So Pillar 2 applies to companies with over 750 million euros of global consolidated revenue in 2 of the last 4 years. And it applies to, it applies on a jurisdiction by jurisdiction basis. So if you have multiple entities in one jurisdiction, you basically look at it on a consolidated basis for that particular jurisdiction. And certain entities are exempt from the Pillar 2 scope, which are basically sovereign wealth funds, not-for-profit organizations, pension funds, and REITs. So on this slide, we'll kind of talk about the core implementation steps for Pillar 2 compliance. The first step is to determine the scope. Right? As I mentioned previously, Pillar 2 applies for entities, the consolidated global revenue of over 750 million euros in 2 out of the last 4 years. And also certain entities are excluded from that scope as well, like sovereign wealth funds, pension funds, not-for-profit organizations, and so on. And then we also need to look at which countries are currently implemented Pillar 2 regulations. Currently, there are, I think, about 45 to 50 countries have already implemented Pillar 2 rules. So trying to see where, in which jurisdiction your multinational enterprise has got footprint is good to know and will fall under that scope. So once you have the scope in place, then you basically identify the entities within the multinational group to kind of map them based on the type of entity, whether it's an operating entity or a permanent establishment, a branch, or a transparent entity, and helping them map those entities will kind of help us get to the next step, which is calculating the GLOBE income. The GLOBE is an acronym. It stands for Global Anti-Base Erosion Income. So calculating the GLOBE income, you'll have to look at the financial statement of that jurisdiction, consolidated financial statement for that jurisdiction. And then you've got to make some adjustments to the financial statement itself, factoring in for dividends, equity gains, foreign exchange gains, and stuff like that. And once you do the calculation for the global income, then you do the calculation for the cover taxes. And then the next step would be to calculate the effective tax rate for that particular jurisdiction. If the effective tax rate is less than 15%, then a top-up tax is applicable. Now, the way the top-up tax is applied is through charging mechanisms available within Pillar 2, which is the QDMTT, UTPR, and IIR. Basically tells which entity within the multinational group will have to pay the top-up tax, whether it's domestically within that jurisdiction or any other entity within the group will have to pay the top-up tax. Then finally, you have a compliance requirement to file the Global Information Return, or GIR or GIR, which needs to be filed along with the tax return. And it will have all the details on the global income calculation, the top-up tax. There are some safe harbor in place that are available. There is a transitional CBCR safe harbor, which is available until 2026. What it essentially does is it can basically use the CBCR report data to calculate the effective tax rate. And if it does pass any of the 3 tests, then you are exempt from the global income calculation and also payment of the minimum top-up tax. So some of the safe harbor that is available is the de minimis safe harbor. So if you're less than 10 million euros in revenue or 1 million euros in profit, then you pass the test. And then you also have the ETR test, which is like if you're already having a 15% effective tax rate, then you are exempt from having any more top-up tax to be done or any global income calculation that needs to be done. And then finally, if you're a routine entity performing routine functions, then also you're exempt from calculating the global income or paying any top-up tax. So with that, we'll get to polling question number 3.
All right, our third polling question is, how do you currently manage compliance reporting for equity compensation or similar employee-based benefits? A, fully automated, integrated with payroll/finance systems. B, combination of automation and manual reconciliation. C, entirely manual processes. And D, not applicable to our organization. We'll give everyone about a minute to respond here.
And while we're waiting for the results here, an interesting question came up here, Ravi, specifically around the top-up tax. I think the question here is, where did this go? Like, what jurisdictions do the top-up taxes go to? Does I would imagine that does the tax jurisdiction have to participate? How does that work? Or what have you seen?
Yeah, so there is a QDMPT kind of supersedes all the other 2 charging mechanisms in place. It's a qualified domestic minimum tax. So if that country has that QDMPT rule in place, then that country will get the top of tax. If QDMPT is not in there, in that particular jurisdiction, then the IIR, the income inclusion rule, will begin, and the ultimate parent entity will get the share of the tax. And if IIR is not in place, then UTPR, which is an under-tax profit rule, which basically will then see which entity will be able to collect that or pay the tax.
Thanks, Ravi.
All right, let's take a look at the results.
Yeah, I'll quickly go through the results. So 45.3% for a combination of automation and manual calculation is the majority there.
Yep, looks like somewhere in between.
Yeah, guess so, yeah.
Great, I'll take it from here. Now that we've talked about what Pillar 2 is, the bigger question here, at least for me, is on the data management side. What does that mean? So let's talk about what happens when Pillar 2 now has to play along with the data that your organization has. When it comes to Pillar 2, the challenge isn't just understanding the rules, which we've highlighted initially. And by the way, these are just a high-level summary of it. There are actually more detailed rules to follow associated, especially as it comes to the question about where do the top of taxes go. So so fundamentally, for data management perspective, it's having the right data foundation to comply. Now, that data falls into 3 dimensions, which we'll talk about here a little bit after this slide, but we've highlighted here some questions that you may want to ask your organization to think about your data management itself. So think of these as the flow of information, so specifically data sources, processing and validation, and compliance outputs. It basically says, where does your data come from, how it's checked and transformed, and what ultimately gets reported. We'll break these down because weaknesses in any one of these areas can create real reporting risks. By the way, this is where Baker Tilly, at least my team, spends most of our time. We act as a liaison between these different data sources and key stakeholders, mainly our tax and accounting folks. So as we go through these dimensions, I'll highlight where the real-world challenges show up and how we've helped clients bridge those gaps. So the first dimension is data sources. For Pillar 2, information has to flow from multiple places. We've got your HR, your payroll, your ERPs, you have your local ledgers, tax systems, and of course your equity compensation platforms, which is my my bread and butter, at least from my career perspective. On paper, that sounds very straightforward. In reality, these systems rarely line up neatly, and I think we saw from the poll that there's some automation, there's some integration, but not quite fully there. So different owners, different formats, and different levels of detail, it's a recipe for silos and gaps, which I'm sure most of us have already seen in our organization. And when those gaps hit Pillar 2 reporting, they quickly turn into risks. So wanted to make sure that this is put out there, that these are the data sources you'll need to consider, and we're just going to filter down to how those translate down to the compliance reporting that you'll need to take care of. So the next one, we'll call data processing and validation. Once you've gathered your data, now the next challenge is processing and validating that data. This is actually where the hard work begins. For the data folks out there, this is along the extract, transform, and load component of the work, or ETL for short. This is where we standardize different formats, mapping them to the right categories. The hard work of reconciling the totals and putting in controls to make sure nothing slips through. If this step isn't done well, you can't trust what comes out the other side. And for Pillar 2, even small inconsistencies can cascade into major reporting issues. I think in the things that I've seen so far, things like exchange rate, for example, whether you're using a daily spot rate or is it the average of the monthly exchange rate that you're using, and how that comes through in the system is also consideration needs takes into place and needs to be considered for your organization. So our role here has been to create that discipline. That's the big one, making sure that information from different teams is not only pulled together, but transformed into something consistent and reliable that tax and accounting can stay behind, because ultimately they will be the owners of this information. And then finally, we have our compliance outputs. We've already talked about GLOBE. That's the information return. And GLOBE, once again, stands for Global Anti-Base Erosion Rules. You can think of it as a playbook that makes Pillar 2 work. Pillar 2 is what this, standard. GLOBE is how to get to that standard. If Pillar 2 is the Global Agreement of Minimum Tax, GLOBE is the recipe for everyone who follows to make sure that the agreement is applied consistently. Once again, that word consistency is being mentioned here again. In practice, this means taking financial accounting data and adjusting it under a standardized set of rules so that income and tax rates can be compared across countries. That's the big deal here. How can we make comparable set of data that we can rely on? The goal is to make sure everyone's jurisdiction's effective tax rate is measured the same way, thereby closing loopholes and preventing profits from slipping through the cracks in the system. As we go through this, just think about the fundamental purpose of Pillar 2, and which was created by OECD. And so just making sure that we have equitable treatment of taxation across the entire globe. And once again, we go back to where we started with we've talked through the three dimensions of the data, which were sources, processing and validation, and compliance outputs. And here we are just bringing them all together again. The bigger takeaway here is that these aren't just technical steps. They raise real governance questions every organization has to answer, regardless of whether you're in scope for Pillar 2 or not. Basically, who owns the accuracy of your data? That always seems to be a question on who owns it, because it'll be the one who manages it and who updates the data, who controls it. The next one is what controls ensure it is complete and consistent. And ultimately, going down the list here, why would it stand up or fail under regulatory scrutiny? And consistency, once again, is key, and making sure that the processes and controls you put into place can withstand this scrutiny. This is where the process shifts from the mechanics, where we talked about Pillar 2, and now we go to accountability. And that lens of accountability is important as we turn to our next focus, because what happens when Pillar 2 meets equity compensation? So up to now, we've been talking about the data demands in broader terms. We talked about Pillar 2 as a global concept. We have jurisdictional tax rates. We've talked about entity structures that's relevant. We have financial accounting data. But things get especially interesting when those demands intersect with equity compensation. On the equity side, the critical data points are grant investing schedules, tax withholding information, and more importantly, employee mobility history. These might seem very different from Pillar 2 requirements, but they share the same challenge. We need to getting consistent, reliable data across multiple systems and tax jurisdictions. And this is where the complexity really multiplies. A grant awarded in one country, vested while an employee works in another, and taxed at a settlement in yet a third, all of that activity has to be tracked and reconciled, and it mirrors the exact same discipline Pillar 2 is asking for on the tax side. Baker Tilly spends a lot of time in this intersection, helping clients translate messy HR and payroll data, equity data, into something tax and accounting teams can actually use for their compliance purposes. This is actually a great example of why Pillar 2 isn't just a tax issue, it's a data issue that cuts across the organization. So what happens when these two sets of data needs actually meet? We first have global footprint, and executives actually go back here, next slide. So what happens when these two sets of data actually meet? First, the global footprint. You have executives and employees are actually mobile, moving between jurisdictions. Even if your company isn't technically in scope for Pillar 2, cross-border reporting is triggered just by people working in different places. Second, complexity in the rules, vesting schedules, performance conditions, and tax treatments vary from country to country. What counts as taxable in one jurisdiction may look completely different in another. And those mismatches create reconciliation headaches. And third, shared data discipline. The same rigor needed to be tracked across grant location, tax basis, and deferred tax asset and equity comp is exactly what Pillar 2 is demanding across organizations. To summarize this, equity compensation is a perfect case study. It highlights how difficult it is to align fragmented data across HR, payroll, and finance, and why strong governance is non-negotiable under Pillar 2. And so just to once again capitalize on the fact that we're talking about equity compensation here, here's how the real complexity shows up. Let's say, walk through life of an award, see how these issues play out in practice. Let's start about grants. The location where the award is issued sets a tax baseline. For example, if a grant is issued while someone is working in the United States, that grant is tied to the United States tax rules, even if they later move abroad. If that location data is missing, reconciling later taxes become almost impossible. Next comes vesting. Mobility often becomes complicated at this stage. Imagine an employee starts in Germany, transfers to the United Kingdom mid-vesting, and then the award vests. Both countries may claim taxing rights. And unless you track that movement, you won't know how to allocate income correctly. And the third one, there's the exercise or settlement. This is the tax triggering event now. Suppose an executive has worked in 3 countries during the life of their award. If each of those jurisdictions may claim a piece of their tax, if payroll and HR data aren't aligned in this case, then you could potentially risk double taxation or worse, missing a withholding entirely at this point. And all of this really boils down to, from the lens of equity compensation, is the reporting of it. All of this information has to flow into the tax and accounting systems. For example, if your HR systems show one vesting schedule and your payroll system shows another, your deferred tax asset could be misstated. And that's where the cracks become visible and where the discipline Pillar 2 requires overlaps directly. So the point is that every milestone, granting, vesting, exercise, and eventually reporting, the challenges are all the same. Fragmented data, multiple jurisdiction, and the needs for consistency is still in place. If you could solve it in equity comp, you're building exactly the kind of data governance Pillar 2 is asking for. And with that, we'll actually, before we go into the polling question, I just wanted to come back here. I think there was a question. Did we already answer that? What does OECD stand for? Ravi, would you mind mentioning that again for us?
Sure, yeah. So the OECD is the Organization for Economic Cooperation and Development. It's an international organization.
It's a mouthful. And how many entities are actually playing along with them?
38 member countries, but there are many other participant countries as well. So close to about 140 countries rely on OECD guidelines for all tax reform.
Well, excellent. Why don't we get into our fourth polling question here?
All right. Which of the following challenges is most relevant to your organization today? A, coordinating data between tax, finance, HR, and payroll. B, managing manual processes for complex reporting. C, transfer pricing documentation or related compliance. And D, preparing for potential new reporting or audit requirements. And we will give everyone about a minute or so to submit their question. And just a reminder here, if you would like to receive CPE credit for today's webcast, you'll need to respond to at least 3 of the 4 polling questions. All right, looks like we're slowing down here, so let's take a look at the results.
All right. I'm not surprised in that first answer. Coordinating data between tax, finance, and HR and payroll is probably a big one. followed shortly by managing manual process for complex reporting. And I've seen many organizations where data is in disparate places, and sometimes duplicative data sits in different places and it's managed a little differently. So that makes sense, and I'm not surprised. Before we go into our next section here, got a couple of questions here, actually just one question here, Ravi, if you wanted to get some feedback on this. As an enrolled agent working in domestic tax return, how can I join OECD Pillar 2 industry? Is that something you've seen?
I don't know exactly the question, Nicole. Maybe you can take it offline, but the OECD is an international organization, and countries are members of that. With regards to Pillar 2, I think your question is kind of targeted to how you could work in a case involving Pillar 2 type engagement. I guess I'm not 100% sure what your question is, but maybe we can take it offline. Maybe I can reach out to Nicole.
Yep, that sounds good. Well, let's just go to the next one, and then we'll tackle that and just see how we can come to a conclusion here in our presentation. So understandably, majority of our folks here also may not be subject to Pillar 2, but we wanted to conduct this presentation because it highlights this need, or at least this increasing trend in the industry itself, tax as a whole, of this demand for rigorous data consistency and data management. So one of the key points we want to emphasize here is that the challenges we've been talking about don't stop with Pillar 2. Once again, even if your organization as a whole isn't directly in scope, or even if you personally don't touch Pillar 2 compliance, the themes are already shaping expectations across the reporting environment. They affected the way the data is requested, processed, and shared at every level of the company. So first, what we've noticed is data requests will increase. Larger customers, parent companies, and investors may begin asking for detailed jurisdictional data. We've seen companies that aren't in scope of Pillar 2 are still being asked by their parent entity to provide jurisdiction level information because the parent has to comply, and they can't do that without reliable data from their subsidiaries. Second, process expectations will rise. It's no longer enough to provide rough numbers here. Stakeholders expect reconciled, well-documented, and audible data as a baseline. That means moving away from ad hoc reconciliations and towards standardized, repeatable processes. Third, technology gaps will start to show, and I think this is the critical piece here. Manual processes, especially in this world of big data that's coming through multiple sets of databases, spreadsheets stitched together is just not going to cut it. Emails, data sitting in your emails aren't just going to cut it. They may work today, but they won't keep in pace with the new demands. And that's where we're having strong data governance and automation in place makes a big difference. And this is where, once again, our group has seen this in a lot of the companies that we've worked with, is how do you, I guess, stitch together this data to something meaningful that, number one, complies, and also, more importantly, for the clients themselves, get valuable insight on their organization as a whole. So we try to help clients get their data structured, clean, and consistent. And then fourth, cross-department coordination will matter more than ever now. Tax can't do this alone. Finance, accounting, HR, payroll, and local controllers must all align on a common framework within their organization. This is also where expertise from my colleague here, Ravi, who really understands the tax technical side of this, comes into play. It's one thing to structure the data well. That's what I do well. But it's equally important to interpret it correctly and implement the right tax treatment. And that's why whenever we go into these projects, I always bring along a tax specialist or an accounting specialist, depending on the nature of it, because I can see the data, but being able to interpret what that data means is necessary to be able to tell your story. And finally, this all points to a competitive advantage opportunity. Companies that can consistently deliver clean, reconciled, and ready-to-use data don't just reduce the risk. They stand out as strong partners to larger multinationals. That's why we stress both sides of the equation. Get your data management right and apply the technical expertise to make it meaningful. To bring this to life, let's take a look at a real world case. This one is not about Pillar 2. Specifically, it highlights the same themes: the importance of reliable data, the risk of mismatches, and the scrutiny that comes when these alone is not enough. Ravi, talk to us about Medtronic.
Sure. I think even before we get to this case on Medtronic, transfer pricing rules are there as part of the local country legislation across the world. And what essentially the rule says is that you got to treat intercompany related party transactions as if they're happening between unrelated parties, or and happening at arm's length, right? So the word arm's length is as if it's happening between unrelated parties. While when you're looking at transactions where you're looking for market data, it's easy to find comparable data in the public domain for certain types of functions and activities like service. But where it becomes really critical in applying transfer pricing methods is when it comes to valuation of intangibles, because there is no market data for such kind of unique intangibles. There are rules, and the OECD guidelines have methods to value intangibles, but often has a lot of gray area subject to litigation by tax authorities, which is what happened in the Medtronic case. Medtronic, just a high-level overview, is a medical device manufacturing entity. It has its headquarters in the US, and it has a subsidiary in Puerto Rico, and has subsidiaries in other countries as well, but this case involves the transaction between US and Puerto Rico. So US licensed its IP, or intellectual property, to its subsidiary in Puerto Rico to manufacture a medical device and then sell globally. Puerto Rico licensed the IP from the US and paid a royalty for the license of IP, for the use of IP. The IRS challenged that the payment that MPROC, the Puerto Rican subsidiary, paid to the US was not arm's length, and they adjusted the taxable income to the tune of $1.6 billion. Now you can see how high that adjustment is, and the resulting tax is also really high for Medtronic. Medtronic appealed that to the tax court, and the court case went to the tax court, and the tax court basically sided with Medtronic and said that comparable uncontrolled transactions of the cut method is acceptable method, but with certain methods. So they did change the taxable income for Medtronic's US, but it was not anywhere close to what the IRS was. And finally, the IRS appealed, and then the case came back to the tax court. But in this case, the tax court did make some adjustments. They did kind of accept certain arguments from the IRS, and also some tax court came up with an unspecified method, and then the value payment that Puerto Rico paid with close to about, I think about 500 million, not anywhere close to what the 1.2% of the IRS was starting. So what it really goes on to show, Mark, here is that any transaction involved IT is highly litigated. So it's very important that taxpayers have a well-documented transfer pricing that defend their transfer pricing, especially when it comes to license of transport or utilization or anything like that involving transport, just to make sure that they have a very principled position with regard to the audit. Because audit is here, the audit started in 2016, and it is still on. The IRS will very likely appeal the latest court decision which came out. So this goes to show that transfer pricing paid is not exact science. So therefore, there is a lot of areas where the IRS go after and try to win such cases, get more revenue from tax. So I think that another reason why transfer pricing documentation is very important. A thorough functional analysis, having corroborative analysis to support with regards to applying methods like the cut method, evaluation factors, also very useful. And in some cases where we also recommend advanced pricing arrangements with revenue authorities so that you have certainty on the type of thing.
So I guess, Ravi, just as we're going through this, I'm curious. I know this one is specifically around the area of intangibles. Are there other areas of, I guess, the financial statements, if I'm looking at it, that is also could be impacted? I've talked about equity compensation, and in this particular case for transfer pricing, we're talking about intangible property. Are there other areas or accounts that you've seen in your work that's also been impacted by this, or can be impacted?
Yeah, I mean, transfer pricing, as I mentioned, it's trying to ensure that the intercompany transactions are priced at arm's length. With regards to IP, most companies, there is an incentive to kind of shift profits to low tax jurisdiction by just papering the contract, right? So, but whereas if you're trying to move a manufacturing plant overseas and stuff, it becomes extremely complex from a business perspective. IP transactions are kind of easier in that respect because you just have to enter into an intercompany agreement with your foreign affiliate, and then you are able to transfer IP from a high tax jurisdiction to a low tax jurisdiction, which kind of falls under the debt strategy that we previously talked about, right? Another area where tax authorities or taxpayers kind of take a position is with regards to intercompany loans and guarantees. That there you see that it's easier for companies to move money across to related entity, other part of the globe, and charge very low interest on those loans, and thereby paying less tax in that jurisdiction. The lender will receive less interest income, and the borrower will be able to get tax deduction. So I think that is another area where you see there is a lot of litigation happening in the public domain and in many countries, especially Australia and India, have very strict rules on capitalization rules on what constitutes debt and what constitutes equity, and the intercompany payment of interest is usually a question of debate by tax authorities.
Got it. And I know we do. I want to recognize we do have stock administrators in this call, and would like to recognize them. And some of the questions that have come up here is, what's the biggest cultural shift companies need to make to prepare for these kinds of reporting demands? And I try to take that, and I think for the folks who aren't in tax and accounting, it's understanding it's not just the tax department in this case, and usually in my experience, they tend to be the last individuals who find out about the changes in data. Once again, this is equity compensation specific. That being able to have conversations around how data is created, and where's that stored, where's the source of that data, and how are changes related to that data being managed. In fact, whenever one of my clients, whenever a new project or a new tax jurisdiction comes up, it's often stock admin. We have our accounting and tax always side by side in that case, providing input into how these designs should continue, because while we do want to take care of the employees who are receiving the benefits of the stock compensation, we do want to make sure that that subsequent data does transfer to our accounting and tax folks. And so being able to understand who are your tax department individuals, your finance accounting individuals are important in developing that relationship, regardless where you are in the stock administration hierarchy, because those are just going to be helpful to those individuals in being able to provide the data that they need. Another question here, Ravi, once again for you, if you don't mind. Would and I think probably going alongside with transfer pricing, we talked about Medtronic in this case. Do you know what potential consequences, or at least have you found any potential consequences where the IRS themselves have found, an organization that has violated or has done something wrong? Like in this case, Medtronic I think the case is still ongoing, but are there other entities out there that may have been impacted by this already?
Yeah, I think a lot of the recent cases involving IRS and the taxpayer has been related to IP, licensing of IP, or cost-sharing arrangement of IP. Think about all the big names that has come out lately. Facebook, then we also got Amazon. We also got now the recent case that came out in Australia with Pepsi. All of that actually relates to the payment for IP, whether it is adequately compensated or not. And it's usually a highly contested thing just because of the nature of the intercompany relationship of the transaction, right? Because it is difficult to find market data for IP. So you have to rely on methods within the transfer pricing regulations or the OECD guidelines to be able to price those intercompany transactions. And the underlying theme is, the underlying message is, need to have robust documentation to support your transfer pricing position. You need to have a sound function analysis. You need to which talks about who does all the development, enhancement, maintenance, protection, and exploitation of IP. The same key concept which came out from the OECD Debt Initiative. And to clearly show what substance is there with the IP holder, how it is getting exploited, what is the compensation for that. All those things need to be clearly delineated in the transfer pricing report and document. And then if you, in back of the envelope, it's always good to have a probability analysis so that in the event of an audit, you also have a what we call as a benchmarkable study, or a CPM or PNMM type analysis, wherein you're not really valuing the IP directly, but you're valuing the IP indirectly, which is what normally the IRS go after. And that's what happened in the Medtronic case as well. They treated the Puerto Rican subsidiary as just a routine contract manufacturer and giving a routine profit to them, and all the residual profit, what they argued was for the payment of IP. So having that back of the envelope analysis as well is helpful. And then, it's also good to have an advanced pricing arrangement if you're very uncertain about whether it will really hold good under an audit. Because an advanced pricing arrangement is you're entering into an agreement with the tax authorities in advance, saying that this is my transaction, this is how I'm going to price this transaction, and these are all the critical terms of the transaction. And then when you have that agreement in place, as long as you're within the critical terms, and if you're pricing the transaction like how you agreed with the tax authorities, then you are covered for that period of time. So I think those are all steps companies can take to make sure that they avoid such lengthy litigation.
Great, thanks, Ravi. Any final words for our audience here before we take off?
Yeah, feel free to reach out to either Mark or myself or myself for transfer pricing work. Any kind of compliance about Pillar 2 or IT planning, IT migration, financial transaction analysis. I think we have a team help you out with any of your transfer pricing.
Wonderful. Well, thank you. I'll turn it over to Alia. Take it away.
All right. Thank you, Mark and Ravi, for a great presentation today. If we didn't have time to answer your questions, we will do our best to follow up with you after the webcast. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will be emailed within 3 weeks should you have any difficulty downloading it now. Here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Please also visit mossadams.com for future webcasts and other resources to help elevate your performance. Thank you for joining us, and we hope you'll join us again next time.
Thanks, folks.
Thanks.